So, what if I told you that millions of us are probably overpaying on our taxes, even with the new, so-called simplified regime? It really feels like all our options to save tax just poof, disappeared. But what if there's a secret playbook? Well, today we're opening it up. We're going to reveal 5 powerful, kind of lesser-known strategies that the pros use to slash their tax bill, even in this new system.
And this is the question on everyone's mind, right? The new regime was supposed to be simple, but for a lot of people, it just feels, well, restrictive. If you've been looking at your pay slip, feeling frustrated by the lack of deductions, you're going to want to stick around. We are about to unlock some serious tax-saving potential that you probably didn't even know existed. Okay, so here's the game plan. We're going to start with some hidden perks that are probably lurking in your salary right now. Then, we'll get into the art of strategic gifting. After that, we'll tackle something called investment harvesting, find a great tax break for your side hustle, and finally figure out how to make your idle money work way, way smarter. Let's do this.
All right, our very first play is all about finding the money you're leaving on the table. We're talking about benefits that are already baked right into your salary structure. These are deductions that work perfectly with the new tax regime, and you might not even realize they're there. Now, what's really cool here is that we're not talking about your contribution. We're focusing on what your employer puts in. So when your company contributes that 12% to your EPF or up to 14% to the NPS on your behalf, that money, it's invisible to the taxman. It's not counted as part of your taxable income. That's a direct, totally effortless way to lower your tax bill.
And here's the kicker. There is a huge combined limit of 7.5 lakh rupees per year for these tax-free employer contributions. For anyone earning a decent salary, this is an absolutely massive, completely legal way to shrink your taxable income. And you don't have to invest an extra rupee to do it. It's a total game changer. Okay, on to our second play, the art of gifting. Now, this is a pretty common tax planning tool, but it's also where a lot of people make a really critical mistake. And it all comes down to not understanding something called clubbing rules. Let's clear that up right now. And this makes it super clear. Look, if you gift a chunk of money to your spouse or your minor child and they invest it, well, any income they make from it gets clubbed right back with your income, and you're the one who pays tax on it. But, and this is the secret sauce, if you gift that same money to your parents or an adult child, any income they generate is their own. It is not added to your tax bill. Big difference. Oh, and here's a quick bonus tip if you're getting married soon. Any gift you receive for your wedding is 100% tax-free. The only catch? Documentation. If you're depositing a lot of cash, just keep a neat little list of who gave you what. Trust me, the tax department might want to see it later.
All right, time for strategy number 3. And this one's for all the investors out there. It's a really proactive move called tax gain harvesting. Basically, it's about strategically cashing in on some profits from your investments every single year to legally slash your future tax bill. So, what on earth is tax gain harvesting? Well, in India, the first 1.25 lakh rupees you make in long-term capital gains from stocks is tax-free every year. This strategy is all about selling and then immediately rebuying your investments to make sure you use that tax-free limit. And doing this has this amazing side effect that can save you a ton of money later on. And look how simple it is when you break it down. It's just 4 steps. First, find investments you've held for more than a year. Second, sell just enough to book a profit of up to 1.25 lakhs. Third, enjoy that profit completely tax-free. And fourth, this part's crucial, immediately buy back those same assets. That way, you don't miss out on any market gains.
And this quote right here, this is where the magic happens. Let's say you invested 10 lakhs and it grew to 11.25 lakhs. After you do this harvest, your new official purchase price becomes 11.25 lakhs. You've just reset your cost basis higher, which means when you sell for real years from now, your taxable profit is going to be way, way smaller. It's brilliant.
Okay, let's move on to play number 4. This one is for anyone who's got a side hustle going on. Whether you're a consultant, a YouTuber, a freelance writer, whatever, you can save a serious amount of tax if you just stop thinking of it as extra income and start treating it like a proper business. So once you declare this as business income, you can legally deduct all your related expenses. We're talking software, that new laptop, fees you pay to an editor, all of it. This shrinks your taxable income down to just your net profit. And there are even special sections for consultants that let you just declare 50% of your total revenue as profit. It simplifies things like you wouldn't believe. And now for our final play. This one is all about where you keep your extra cash. So many of us just let money pile up in savings accounts or FDs, and we don't realize how much we're just giving away to taxes every single year for no good reason.
See, here's the problem. The interest you earn from fixed deposits and savings accounts is fully taxable. It gets added right on top of your income and gets taxed at your highest rate, which, for many people, is 30%. It's honestly one of the least tax-efficient places you can park your money.
I mean, just look at this chart. The difference is night and day. That FD interest gets slammed with up to 30% tax, year after year. Now compare that to the long-term gains from an equity mutual fund. That's taxed at a flat 10% and only on the profit above that 1.25 lakh tax-free limit. The savings are just enormous.
And here's the other superpower of mutual funds. You don't pay a single paisa of tax until the day you actually sell. This is called tax-deferred growth. And what that means is your entire investment, including all the gains it's making, gets to keep compounding and growing year after year without the taxman taking a slice and slowing it down.
So there you have it, your new tax-saving toolkit. First, max out those employer contributions. Second, gift your money smartly to parents or adult kids. Third, harvest those investment gains every year. Fourth, turn that side hustle into a business. And fifth, get your idle cash out of FDs and into more tax-efficient funds.
You see, these strategies prove that even inside the new tax regime, there are still some really powerful moves you can make to keep more of your own hard-earned money. So the only question left is, which one of these plays are you going to run first? We hope this has helped you feel a bit more empowered to take control. Thanks for tuning in.